In a world where China's manufacturing once reigned supreme, why are big companies leaving China? In this video, we will delve into the heart of the Chinese economy, exploring the reasons behind this exodus, the specter of China deflation, and the impact of Xi Jinping's policies. China is struggling, and the world is watching. China has been a manufacturing giant for a long time. In fact, it's responsible for almost 30% of all manufacturing worldwide. This means that one country, China, is behind 30% of all the things made on Earth. This data comes from the United Nations Statistics Division, which reported that China contributed to 28% of global manufacturing output in 2018. This is more than 10 percentage points ahead of the United States, which used to be the largest manufacturing nation until China overtook it in 2010. This manufacturing is a big part of China's economy, contributing about 30% to its GDP. In comparison, the United States only gets 11% of its GDP from manufacturing. So why did other countries choose China for manufacturing? Well, a few things played a role. Cheap labor, great business environments, less red tape, low taxes, and competitive currency practices. Many countries like the United States sent their manufacturing to China, which helped China's industry, but hurt other nations. China's manufacturing success didn't just boost its economy, it reshaped the global landscape. China went from being a low-cost factory to a tech leader, affecting global supply chains and becoming a major player in world diplomacy. China is now a top partner for many developing economies in Asia, Africa, and Latin America. China's rise has given it economic power and influence, but some worry about how it uses that power. This sparks debates about whether the world order can stay steady with China's growing economic might. Now that we've seen how essential manufacturing has been for China, it's time to delve into why China is facing a manufacturing crisis. This is where the real story unfolds, so stay with us. China's manufacturing crisis is a complex issue that didn't happen overnight. It's the result of two key factors that have built up over the years. The first factor is the ongoing rivalry between the United States and China. In 2019, the U.S. was China's biggest customer, buying nearly 20% of their exports, worth a massive $2.5 trillion. But things went sour when the U.S. imposed a 25% tariff on some Chinese goods due to trade imbalances and security concerns. China fought back, and this trade war caused worldwide financial turmoil, disrupting global supply chains. Losing a big chunk of your market is tough for any country. Even with a new U.S. administration, tensions remain as they strengthen alliances against China and limit access to advanced semiconductors, which are crucial for technology and manufacturing. It's like cutting off the oxygen supply for China's industries. This conflict is harming China's position in the world. As the U.S. and its allies seek manufacturing elsewhere, money follows manufacturing, and when it goes away, it's bad news for China. But there's more to the story. The second big reason is something we all remember: the pandemic. COVID-19, a virus from Wuhan, China, quickly spread worldwide, causing factories to close, roads to empty, and the world to go quiet. When the pandemic hit hard, it disrupted the global supply chain. China, a major manufacturer, was hit hard. The pandemic changed how businesses work. China had to close many factories, taking strict measures, even if it meant punishing its own people. When factories tried to reopen, the world had moved on. Demand had shifted, leaving China with a puzzle to solve. The pandemic made many big companies realize they relied too much on China. It was a wake-up call. They saw that everything, from materials to factories, depended on China's supply chain. But that's not all. There's another important factor: changing trends. Due to trade tensions between the U.S. and China and strict measures, many big companies left China for stability and growth. China's exports slowed in 2019, with no growth from 2018 to 2019. Around 40% of companies relocated or considered it, like Hasbro and Nike. This was due to trade tensions, and it's significantly affecting China's manufacturing. So it's not just one thing causing the manufacturing crisis. It's a mix of political tensions, the pandemic, and changing trends. But what's next for China's manufacturing industry? How can it adapt to these changing circumstances? To understand that, we have to explore the reasons behind China's manufacturing manufacturing crisis. It's vital to understand that many businesses are looking beyond China. They're relocating to other Southeast Asian countries, and there are both push and pull factors at play here. One big push factor is rising labor costs. China's labor used to be cheap due to its massive workforce, but wages have been rising about 7% annually for the past 5 years. This trend is expected to continue. Brands like Nike and Adidas are looking for lower production costs, which led them to countries like Vietnam and Indonesia. These places offer cheaper labor and production, making it more cost-effective for companies. More than a third of China's lost exports to the U.S. market went to countries like Vietnam, India, and Thailand, which excel in low-cost manufacturing. China, on the other hand, is shifting toward high-value manufacturing. Now let's talk about the pull factors that attract companies to new destinations. Vietnam stands out as a big winner, attracting companies with favorable conditions. In response, China is implementing its Made in China 2025 plan, investing over $1.5 billion to shift to high-tech areas like next-generation IT, advanced engineering, IoT, and smart appliances. However, like getting braces for a better smile, the initial charm is fading for some big companies as China's manufacturing landscape evolves. Many firms are diversifying their manufacturing across the world to ensure a stable supply, reducing China's role in the global supply chain. China's changes are also driven by a labor shortage, as younger workers are less interested in traditional factory jobs. To cope, companies have 3 choices: pay more, embrace automation, or relocate to cheaper places like Vietnam or India. So who are the big winners in this unfolding story amidst China's manufacturing challenges? Let's take a closer look at the nations benefiting from China's changing fortunes. Vietnam has been doing exceptionally well. More than half of what the U.S. used to import from China has moved to Vietnam. This has boosted Vietnam's economy by over 7.9%. Industries like furniture, footwear, clothing, electronics parts, and machinery are thriving. The U.S. is Vietnam's top export partner, accounting for almost 30% of its total exports. Vietnam's appeal lies in lower labor costs, much like China's rise. But companies like Foxconn, Apple's manufacturer, are investing heavily here to save money. They understand that paying less for quality is smart business. Vietnam's future isn't just about low-skilled work. The electronic sector is on the rise, and it's even becoming the world's leader in display production. India, with its vast land and a young workforce, is also gearing up. Apple has moved some iPhone production here, and they might do the same for iPads. Experts predict that by 2025, 1 in 4 iPhones will be made in India. Thailand is another country seizing the opportunity. It's a hub for car parts, vehicles, and electronics. Big players like Sony and Sharp are manufacturing here, while even Chinese firms are relocating to cut costs and avoid tensions. Thailand's foreign investments tripled between 2020 and 2021, putting it in a better position for growth. Bangladesh is excelling in the garment sector, contributing to 85% of its exports. Rising labor costs in China have helped Bangladesh. Labor is way cheaper here, with workers earning $120 per month compared to $670 in China. This makes Bangladesh a more attractive choice for manufacturing operations. Mexico is in direct competition with China, especially as U.S.-China trade relations strain. It's expected to gain about $27 billion in lost trade between the two. Sectors like food, metals, pharmaceuticals, and automobiles are investing heavily. Ford invested $260 million in Mexico, while Volkswagen is putting a whopping $763 million into its electric vehicle plant. This shows that Mexico is a significant growth area, particularly for cars and food manufacturing. It's important to note that while these countries have made significant strides, China remains the world's manufacturing powerhouse. These emerging markets primarily engage in labor-intensive and low-value-added manufacturing, and they don't yet have the extensive industrial and supply chains of China. Moreover, China not only manufactures but also consumes many of the goods it produces. In 2020, global companies had $1.4 trillion of domestic sales within China, surpassing their exports of $900 billion. These countries, while promising, still have some way to go to replace China as the global manufacturing hub. However, they are inching closer, and with the same factors coming into play, the shift could be significant. development. If you want to learn more about countries like India and Indonesia and how they are slowly but surely becoming economic powerhouses of the world, click the video on screen now. We've gone in depth of what the countries are doing. You'll be surprised how these countries are taking the reins from China.